All right. Well, welcome everybody to this week's stock market review. My name is Bennett McDowell with traderscoach.com. And once again, great to be here with you. All right. Before we get started, I'm going to go over a few administrational items and then we'll take a look at the charts for the indexes today. I want to go over Bitcoin again, the housing market. I want to make sure I do an in-depth coverage on that, and also to take a look at oil. I want to take a look at TLT on the bonds, gold, and silver. So we want to cover those major markets to kind of get an idea on how they're doing this week. In terms of interest rates, we're going to talk about that. What I'd love for you guys to do right now is in the comments area, go ahead and just, while I'm going through these administrational items like the risk disclaimer and stuff like that, go ahead and type in for me what you think the Fed's going to do with rates this year for the remainder of 2024. And you don't, you can just say, two more hikes, or, no change, or, two more decrease, whatever you think. Okay. Just put it in there. I'd be kind of interested to see what people think overall on that. All right. So let me get going here. Give me 1 second to get set up, and I'll walk you through again some of the administrational items I got to get going on. All right. So first thing, give us a like out there. It takes just a moment to do that now. That helps our channel out, and you're already subscribed since you're here. But if you have anybody, friends that are interested in stocks, send them over here. I think they get a kick out of this. All right, in terms of risk, now I want to talk a little bit about the risks involved in trading, and this is really important because when we talk about markets and we talk about the possibilities of some opportunities out there, nothing's guaranteed in the markets. All right, we work in a realm of probabilities. Past performance, of course, doesn't equal or guarantee future performance. And so what you need to do is, of course, always use risk capital. Always contact your financial advisor before operating independently on taking a particular trade or so forth, and make sure it's suitable for you. There's a lot of things that need to be taken into consideration on this, like your tolerance to risk and so forth. So just run that by them as a litmus test, so to speak, to make sure some of the things we talk about are suitable for you personally. And then also to know how to do or calculate the risk you take on each trade or investment. And that's really important. I've written a couple of books on that I'll share with you right now on money management. One of them was published by Wiley Trading, and then my other one, Money Management for Traders, is one we put together here at traderscoach.com that basically is like a cliff notes of the more detailed book, but it gives you the information you can get started with right away. My newest book, The Art of Trading, being published again by Wiley, is coming out this year. And then McGraw-Hill published my Elliott Wave Technique Simplified, which is a really outstanding book on the Elliott Wave and how to apply a percentage to the wave counts. So you can check out all that. And we'll put a link in the recording below, but you can go to our website for that as well. All right, so let's talk a little bit about economic reports here. I'm going to go full screen here for a moment, and I'm also going to enlarge this so you can see this better on your end. Okay, so before we get going, let me just do a quick audio check just to make sure everybody can hear me okay. Warren is saying one cut. I'm not sure what that means. I guess one interest rate cut, right, Warren? I think maybe you're right on that. That's kind of my feeling as well. But I'd like to see what everybody else thinks on that as well. So feel free to chime in on that. Some people even thought there was going to be going into the year, 6 rate cuts. But of course, that's not going to happen. And I think probably more likely we'll be lucky if we get 1 cut. I was thinking maybe 2, but I don't think so. All right, not right now. Inflation's a little too sticky right now. It is an election year, so anything is possible. And I think because it's an election year, that's why we might actually get 1 cut, right? But we'll see, because I could see no cuts as well. All right, that may be the surprise that comes down the tube later this year. Kumar's saying 0 to 1 cut. Okay, yeah. So everybody, let me know and tell me what you think, because I'll check those out as we progress here. All right, so today is Wednesday, May 8th, and I want to go through the economic reports coming out. So we got wholesale inventories today. There's no FOMC minutes, but we got a lot of Fed speakers speaking. And then Thursday, initial jobless claims, another Fed speaker, and then Friday, consumer sentiments coming out, monthly U.S. federal budget coming out, and again, a bunch of speakers. Okay, so I don't really see anything on the economic front that's going to cause too much trouble for the markets at this particular point. All right, so let's keep going here. All right, so we're going to look at charts. And when I do, the reason I'm showing this is that we're going to use software that I created over my last 30 years of trading the markets. And this software is going to be on the charts. So just know if you're interested in it, you can go to our website. I'll put a link below as well. All right, so I want to start out with the daily chart on the Dow Jones Industrial Average and explain a little bit what you're looking at here. All right, first of all, when I say it's a daily chart, what that means is that every price bar represents a full day of activity. This is kind of the normal chart you're going to see when you're looking at any type of chart, probably on the internet or in a newspaper, magazine, something like that. All right, so in this case here, we got our software loaded on, these little pyramids. This indicator down here is all part of our software. And I'm not really going to go into detail on that. We have separate videos on how the software works, but I'm just kind of showing you what's on the chart here. Also, too, you'll see these numbers on the chart. This is the Elliott Wave counts. And basically, the thing to remember for this presentation is there are 5 waves in a trend, whether it's an uptrend or a downtrend. And not all of these waves go in the direction of the trend. So waves 2 and wave 4 are usually counter moves to the trend. So it's profit taking, people going, selling out of their position, taking profits, and then it gets low enough again and the trend resumes. And that's usually in the next impulsive wave to the upside. So in this case here, this was a big wave that ended in 2022. And then after that, we had profit taking that resulted in that profit taking wave 4. And then the market rebounded and we went into a wave 5. Now, we use Fibonacci extensions to help us determine the target of wave 5. And so the target for the Fib extensions on the Dow Jones Industrial Average is between 40,281 up to a range or a high roughly of 47,426. And this range is important because usually 70% of the time, if you draw these Fib extensions correctly, the markets actually reach into these wave 5 target zones. 15% of the time, we sometimes get a slightly failed wave 5, but it still qualifies as a wave 5 because it exceeds wave 3, but it doesn't quite make it to the target zone. And then 15% of the time, they're super robust and even go slightly higher than the wave 5 target zone. Now, you must have bearish divergence in this indicator down here. We call this the OWL, which is one of ours, and it stands for the optimum wave locator, which measures momentum. So you need to see bearish divergence when you're talking about making new highs for the end of any type of trend. So we kind of had that, and then we had a big move down here. Now, what I think we didn't quite hit the target zone here, and the weekly chart, which you're not looking at right now, I'll show that to you in a minute, is still bullish in terms of its trend and of some of the indicators we look on, like for example, the PTF, which I'll show you in just a bit. But those indicators are indicating more highs. So I don't think the bull run on the daily Dow Jones Industrial chart is over, or any Dow Jones chart for that matter. So I think we're going to go back up into this target zone before it's all over. Now, the concern is when we reach this target zone, then what happens? Well, then we get a dramatic change in trend, and that would be considered the start of a bear market. And so we do have to be careful about that. So when we hit this target zone and we start to see the market roll over and then start taking out some price levels that will be important to us when that happens, then we're going to start thinking about the market heading down, and it could be quite significant. So that is kind of what is out there in the future, probably more in 2025, I would say at this point. We may get into this top here of course, sometime, within the next, I'll say 6 months, and then we should see some type of move to the downside. It could come earlier, it could come a little later, but it's kind of looking like it's working its way up there maybe now. But we'll take a look at a lower time frame in just a minute to see how that is doing in relation to where we thought the market would pull back on this market pullback that we've seen this spring. All right, so that is kind of the overall synopsis of the Dow Jones, and it spreads over to the other markets like the NASDAQ and the S&P, and I'm going to show you those as well before we leave today. All right, so let me just go to the next chart where I actually have the target zone for this pullback that we've been experiencing recently. And so notice we hit the target just barely. And again, this target has a 70% accuracy rate in terms of when you have a market pull back, it usually goes into this, what we call a Fibonacci retracement zone. So 70% of the time it hits there. And notice we're getting a rebound. I would have liked it to go on a little deeper into this profit-taking target zone. I see an A, a B, a C. The only concern that still lies here is you could have an A, B, and C. So there are A's, B's, and C's in these corrective profit-taking modes. For those of you that kind of are wondering what the heck is he talking about with the alphabets, well, that is part of the Elliott Wave. And so during these corrective moves, they come in the forms of A, B, and C's. So we're not necessarily out of the woods, but as of, and this chart was drawn on May 5th, so that was Sunday. We'll take a look at what it's doing now. But we got above this top here, which is kind of important. And then the next top we're looking at here is way up here. And the difficult things about corrections, of course, is you're not necessarily going to know they're over until they've hit the target zone and then start moving up dramatically, taking out key levels of price. So this would be one. This one was already taken out. So we may have a bottom in the Dow and we may be moving to the upside. But I say that cautiously because until we take out this price level here, all right, it still could fail and go back down into the target zone. So keep that in mind. The next chart I want to show you is the S&P. And on this chart, I have 3 charts. I have a 60-minute chart over here, the daily chart, which is what I was showing you before, and the weekly chart here. So the day 60, the daily. Now, on the S&P 500, what you're looking at here that you didn't see on the Dow, but it's pretty much the same as on the Dow, is on this chart here, this PTF is green. And again, this indicator, when it's green or red, in this case it's green, we're going to have higher highs, and it's usually correct about 75% of the time, which is a very good number for anything in the markets. So when you get some situation like that, that's indicating that this bull run in the S&P 500 as well as the Dow, and we also have it, I believe, on the NASDAQ too, is not over yet. So that's why I don't think we're heading into a crash right now. I think everything we've seen so far is part of this profit-taking mode, which may or may not be over. Now, on this 60-minute chart here, notice this bottom here did not go into the high probability target zone. So remember, 75% we usually get in between these blue lines. So this would have been a move down, a counter trend move in an ongoing uptrend. But we would have liked to have seen it gotten there. 15% of the time they end shallow, so it did meet that requirement. But I'm a little suspect until we start reaching above some of these key levels of support like here before we're out of the woods yet, because we could still sell off and go back into that target zone. So you got to be a little careful here. All right. Sometimes the markets aren't as definable as we'd like them to be. So we have to wait for key price levels, okay, to kind of be triggered in order to gain a higher probability wave count. Kumar is asking, do we also have a wave 4 for the S&P 500? Yes. And that is on this chart here. So it would be kind of a 4 here that we're looking at. And notice here, Kumar, we did not hit the target zone. So that's why I'm a little concerned. But we're seeing some pretty good bullishness in the market right now. So it may be one of these things where we only get the 15% retracement, right? So we kind of want it to get above like 50, let's say 5,200, 5,200, 5,225 before I gain a little more confidence that this correction that we've been in is over. Okay, so we'll take a look at that. That's a 60-minute chart. So that certainly could happen very, very soon. And we still have a red owl over here on the daily chart. So as you know, technically a correction is not over until that goes green. So we're kind of hopeful that it's over, but also too a little reserved, realizing that it may not be. All right, so that's the S&P, and I want to take a look at the NASDAQ, which is very similar. Now, the NASDAQ, one of the things the NASDAQ is different on, okay, is the red PTF here. So that's indicating, unless that changes, that's indicating that this bottom here is not the end of the correction. And now this leads me to believe if the NASDAQ isn't over yet, and that's a very dominant and prominent market in the overall market itself, then that would probably mean that if the market heads down in the NASDAQ, it's probably going to bring the S&P and probably the Dow with it. So we got to keep a little eye on that. Now, it's possible, okay, it could turn green by next week. We'll see. All right. And if that's the case, then that changes things. But we'll see what happens with that. And as you can see, we're nowhere near the target zone for the NASDAQ. My target zone for the NASDAQ, once the high has been reached. Now, this is a wave 5 target zone, which means that when we get into this area, this bull trend that we've been in for a decade is going to be pretty much come to an end. And that's between 19,164 up to 24,880 on the NASDAQ. And we haven't reached that yet. We have gotten slightly above the previous high. So if it doesn't get there, it would be a failed wave 5. But I kind of think that we're probably going to see higher highs in the NASDAQ before we begin the quote unquote bear market. Okay, so keep that in mind. All right, I want to switch to real estate. Before I do, any questions on the indexes? Any question on the market, feel free to ask. Okay, and I'll address that as well. All right, so on the Case-Shiller index, I'm basically jumping to real estate now. And on the Case-Shiller index versus the CPI is what I want to talk. All right, Kumar is asking a question. Is NVIDIA earnings going to prop or crash the market? We'd have to look at the NVIDIA chart. And what I'd like to do with that, Kumar, is have you come back on Friday during our stock analysis Friday session. And we'll take a really close look at that. And that's on YouTube. It's also on Facebook. I do that. And it's free, and LinkedIn as well. Okay. So we'll take a look at that as an individual stock on that day. All right. So on the Case-Shiller index versus the CPI, what I want to go over here again, and I usually do this every week. So for those of you that come every week, it's kind of, basically we're kind of looking for a change here, but we haven't seen one. And we don't see it today. But for those that are new, basically the Case-Shiller is the line here in red. And the Case-Shiller index basically is a real estate index for residential real estate in the United States. And it's the average price of real estate. Real estate is very local. So when one area is doing bad, you can have another area doing good, right? So it depends on your local area. And, the number of subdivisions too now are affecting real estate quite a bit. I know in certain pockets of Arizona, they're still building like crazy and things are selling for the most part. So it depends where you are. Okay. California, look at the prices there. Unbelievable. But if you go to some areas, they're down. Okay. So it depends really where you live. But as an average, prices have been skyrocketing, especially, all right, since the 2000, right around 2011, 12 turnaround after the financial crisis. So you got the Case-Shiller and then you got the CPI under it. And the CPI is that dark, black line rather. And the CPI is the consumer price index measuring inflation. And so as you can see on this chart, it goes back into the 1970s. But as you can see on the left-hand side of the chart, maybe I should just try to magnify this a little bit as well. All right, that will help you see it, I think, a little better. But in the 1970s, you can always see the Case-Shiller has remained above the CPI. And that's why real estate has been a fairly good hedge against inflation, thus an investment as well as a place to live, right? So housing has always been looked at as, especially for new home buyers, as the first big step, all right, in building a financial future, right? Because you buy a house, you live in it, and at the same time, it's an investment. So those kill two birds with one stone. So that's one of the first investments people make. And it's done well, all right? But the only thing is when the Case-Shiller gets inappropriately distanced from the CPI, you have a bubble, all right? So all markets, whether it's stocks, real estate, any market is subject to a bubble at times. And basically, it's a mania of purchasing that kind of gets out of hand, right? It's not normal. So it gets away from the CPI a certain distance, and then it corrects. Now, there's a whole bunch of reasons markets get away from the CPI. You know, for example, in this area here, we had low interest rates, and this was the financial crisis, if you remember, back around 2006 to 2008. And then the market actually fell for a couple of years after that. But basically, back then, you had the mortgage industry lacked a real good qualification period because they started securitizing all the mortgages. So their goal shifted from really a scrutiny of the borrower to let's get as many mortgages as possible so we can sell them on the secondary market. And that was a new type of thing at that particular point for the industry. And so because of the lack requirements, basically, if you could breathe, you could get a mortgage, if you remember back then. And then you had the secondary HELOC mortgages coming out. The real estate industry just skyrocketed, okay? People could buy homes with very little credit income check. They did credit check, but income check, not so much. And people got overextended. And then they had a problem where the economy went through a recession. And basically, people that were overextended couldn't afford their mortgages. And of course, you had all the foreclosures and the problem with real estate then. You know, you had a flood of houses on the market. And of course, that draws the price down. All right, then it got to a level where once again, it was affordable, getting closer to the CPI. And then your bottom occurred. All those bad mortgages were washed out. Interest rates were still low. And then people, the economy turned around, and therefore investment in real estate increased. Then you had COVID, all right, and COVID created lower interest rates. The Fed pumped a ton of money into the markets, probably way too much. And also, too, people actually that got mortgages didn't have to pay them. The mortgages got suspended for a year or two, and then tacked onto the back of the mortgage for the after it was over. But the problem is then everybody during the pandemic was moving out of the cities to get away from that environment into an area, and working at home became normal. Rates were dirt low, and housing just took off. Okay, so the demand for housing were huge. And there we are today. Okay, here we are sitting at prices still high compared to the CPI. And as you can see, it's almost double the distance as it was during the financial crisis. So people watching real estate like me, and I'm sure like you too, kind of realize that housing is definitely overpriced. First-time home buyers, no way they can afford those now. All right, the only people that can afford to purchase anything are people that are either fairly wealthy or got into housing early, all right, and have a ton of equity that they can roll over into a new purchase. Then you had interest rates high now as well. So there's not a lot of supply in the market, which is keeping it up there. The few transactions that are occurring, all right, are not significant enough really to mean much in the market. It's kind of a stagnant market where the prices have been elevated. But if you believe in the fact that historically the Case-Shiller index eventually comes back down closer to the CPI after the bubble bursts, this chart is a little worrisome because you're talking probably a 40% correction, I would say, maybe more, for real estate to come in line with the CPI again. So that's kind of something that makes you think twice about that, right? All right, then the next chart I want to show you, and let me enlarge this one. And this was done by RE Venture Capital, or RE Venture Consulting rather. And this was done back in 2023, and they'll be hopefully updating this summer. But this basically shows home prices versus incomes. And in this current bubble here back, this is a year ago, and even now it's even worse. There's no way that the incomes were anywhere near a point where people can afford this. All right. So again, this chart creates a problem for real estate and also highlights the fact that real estate is in a bubble. This was the financial crisis back here. So once again, we're even worse off than we were before. And so that's why so many people are forced to rent these days versus being able to buy. All right, a couple other charts I want to show you here. Debt to income ratio for all home buyers off the charts. This was 2023. It's even worse now. All right, and let me just show you the next chart here, which is the credit card debt in the US. All right, so this is at the end of 2023. It's probably even worse now. It's $1.13 trillion. All right, and notice how it's come up dramatically since 2021. So when the stimulus was cut off, you had inflation here. People were used to a certain lifestyle because back during the pandemic, a lot of their debts were frozen and they got a lot of stimulus money. And then that ended and their lifestyle was at a certain level that they wanted to maintain. And either they had the income from their job or they had to start financing that on their credit cards. Okay. And then interest rates went up. And that really is causing all sorts of problems in the credit card industry with delinquencies and just basically overextended. Very easy to do. Okay. Very easy for people to fall in that trap. All of us, right? All right. Inventory of single family houses for sale. This was back in 2023. It was 50% below the long run average. You could see it has improved somewhat this year. On this chart here, we can see in February 2024, it was perking off the bottom. So that was a good sign. You know, we'll see what happens with that in terms of a continuation. But from what I hear, it's really kind of pretty stagnant out there. Home buyers' house payments are up about 12.6% year over year here. This is kind of a neat chart because on this chart here, it starts at 2021. Look how low the house payments were there. Interest rates started going up, so the house payments came up. Also, housing started to increase. So you have houses increasing in value, and you also have interest rates going up. So now, as of April 21st, you had a situation where you had the average payment at 7.1% interest at $2,843. Okay, so much higher than down here when it was around, looks like around 1,600. Okay, so in 2021, big difference. All right, that throws people out of the housing market, of course, on affordability. And then on this one here, this is the average home price, how much it is in this year as compared to what it was in 2021. So not only interest rates, once again, but also to the increase in housing is what drives the affordability pretty much out of sight for so many people, unfortunately. All right. So again, something's got to give, okay, in terms of the real estate being affordable for the general public in general, so to speak. And so you got to believe that we're in a bubble here, and bubbles can last a long time. And but eventually they burst, and I don't think it'll be any different this time. And, you know, you always hear, well, things are different this time. But usually, if you, again, believe in the history of the markets, they're really never different. A bubble is a bubble. All right, Bitcoin. Let's talk a little bit about Bitcoin here. I'm going to go to the live charts in just a moment. So Bitcoin was going through a correction, a healthy correction. It needed to. It came up quite a bit. Long term, I'm very bullish on Bitcoin. All right, let me just get that off the table right now. I don't think Bitcoin is going to be a problem if you hold it. However, I do think you've got to realize that it goes through cycles just like any other market. And yes, there is profit taking in this cycle as well. Now, we have not gotten down to the high probability pullback for profit taking here. All right, we did get to the 15% level. All right, and then saw a little burst, but we did not get to the 70% level. We still have a red owl here. PTFs are green here. So I'm not worried about the future of Bitcoin with those green PTFs because they're stating more highs are coming. What I'm concerned is short term. Are we out of this pullback correction, or do we need to go further so we get into that target zone? All right, so if this is a 3, A, B, C, all right, is it over, or is this still C coming down one more time? A little too early to tell. All right, so Bitcoin is in a very precarious level right now, so we're going to have to wait and see. For those of you holding out on buying Bitcoin, I would probably hold out a little longer, and I'll show you on the live charts what I would do on that if certain levels are broken. All right, on the weekly chart far right, you can see bullish, bullish. We're inside a major wave 3 on Bitcoin right now unfolding, and I don't think it's over yet. So I think this is basically a pullback inside a major move on the weekly chart. And that pretty much goes over to most of the currencies. This is GBTC, which is a very famous ETF for Bitcoin. And those of you that don't actually do the Bitcoin, some people prefer just to do GBTC. Again, same dynamics as the other chart. This has a red PTF over here, and this causes me concern that this is coming back down again, which would affect Bitcoin as well. All right, so that's kind of something to think about. All right, I want to get out of here now, and I want to go to the live charts for a moment. And so here's the Dow Jones Industrial Average, and I'm using NinjaTrader with our software integrated inside of it, short-term, intermediate, and long-term charts. So we're kind of moving up. We still got a red, this is the Dow, we still got a red owl here. And so I'd like that to turn green, and then I'd have a little more confidence that we're probably have finished the correction. All right. So until that turns green, anything is possible. So just keep that in mind. But, you know, the market's up a little bit today, but we certainly could see some follow through. And don't forget, it's an election year. So I think probably the Fed is going to do everything they can do to keep things as stable as possible. Let's take a quick look at the crypto market and take a look at BTC in general. All right. So here's the BTC market, and, you know, it's kind of come down a little bit over the last couple days. We still got a red owl here. We didn't hit the high probability target zone. If we did, and we start moving up and get above this bearish pyramid here, then that's a good sign, and we may then be working our way up to the next high. So I'm pretty confident the next high, like I said before, is coming. I'm just trying to gauge whether we've got this correction over or not. So I told you what I would do on this, and let me just bring up some lines here. So if you're thinking about buying it, I'd like to see it get above here, above this pyramid before I would go in. However, all right, where I really want to go in is here, okay? I would really love for this thing to continue on down here. I think this will be a tremendous buying opportunity, and then head on up, okay? Now, if you were long and you didn't want to suffer this correction, you would have been out already, okay? So if you're holding this long term, you just suffer through the correction, but you should have enough confidence based on what the tools are telling us here that after this correction, you'll get more highs. And for those of new, I would hold out a little bit, okay, and purchase if it comes back down into the lower level. So the lower level target zone, just to let you know, is 53,295 to 40,430, pretty significantly low, okay, especially off its top of what, 73,000. So that would be a pretty good buying opportunity. All right, so that is kind of it for there. I want to take a look at oil, and before we wrap it up, I know I'm going a little over, but this is important stuff, I think, to cover. So oil, my target on oil, I'm bullish on oil. We've got a pullback coming here now, but the target on oil is about 100 to 125 on this ETF. So this is USO, the ETF. Of course, there's many ways you can participate in oil futures market, etc. But we've had a nice profit-taking pullback. This has got to turn green on the owl here before I can say this correction is definitively over. But certainly, we're bullish long-term on oil going up higher after this correction. All right, TLT, the bonds. This is the ETF for the bonds. Now, a lot of people are all psyched that we had a bottom in the bonds, and they were psyched back in 2022 as well when we came off this bottom here and started moving up. One of our indicators here was bearish, indicating this was not the bottom, and then it rolled back over, and then it did make a new bottom. All right, so now it's yellow, but this one is red, indicating that we're not the bottom is probably not in still even yet. So I would not go into TLT right now. I know some people are saying bonds would be a good place to go. According to the tools here, no. Okay, hold out a little longer on that. Eventually, it will bottom and it will be a good opportunity, but certainly not right now. UNG, let's take a look at that one. All right, natural gas here. This is the ETF for natural gas. Now, natural gas I've got on my watch list. I want to buy natural gas. I think it's getting down too close to a bottom. All right, very close. We've got a green owl here. We've got a nice move off of here. We no longer have any active short trades, and we have green here. So I'm looking pretty good on here. I would like it if this would turn green, but you know, this is the weekly chart, kind of turns like an aircraft carrier. So it's going to be the last ship to turn. All right, making a wide turn, right? So the smaller ships, which are represented by the smaller time frames, have turned already. So I'm kind of liking this. I think I might put this on a buy list for an early entry. So if you, and then put your stop under the bottom in case we miss it. But this is looking pretty good. We took out this price support level here. So UNG, I'm actually liking. And if somebody asked me if I would recommend this as a buy, I would say yes as an early buy. Okay, so UNG is actually something I think is pretty good. All right, silver and gold, and we'll call it a day here. All right, so silver broke out of its pennant. You can see that on the chart. Pulled back short term. It's reached its target pullback area, and now we've seen a rebound here. So I think probably at this particular point, and that silver looks like it may be heading back up now. Now, one of the things I want to point out here is the strong indicators indicating more highs on silver. So I think silver is something that now is going to go up. You know, it was stuck in a channel for so long. And this channel, you can see on the weekly chart over here, was broken finally here. This is the all-time high here. So I'm thinking probably now it's getting ready to move fairly good to the upside. So I wasn't so psyched in getting into silver earlier because it was stuck. But here I'm kind of liking it. All right. So silver, I think, is not a bad thing. All right. So that's silver. And then I'm going to show gold. I like to show these major ones during this session. Now, gold also pulling back a little bit, but again, using our tools here, notice how strong gold still is. So more highs coming in gold, and we may get more of a pullback here. So, you know, when you have the owl, as this is the optimum wave locator called the owl, which is showing momentum, it's already fairly, it's been green since March. So usually, the longer the owl is green, the more the probability of a profit taking or change in direction is due. And so we started to see that change in direction. It has not gone red yet. So my feeling is on gold, all right, if you're an active trader, it's probably going to go something like this, and then here, go back into the target zone, and then buy in here. All right, and then it should make more highs after that. So I don't think the correction is over. At least it's not a major 4. Now, what's also possible is you could get one more hook up and complete wave 3. That's possible, all right, before it sells off. So again, if you're currently long gold, probably best to just hold it. All right, because it's not going to go down that much more, even if it goes down to the major target zone. But after it hits here, then we'll have to redraw these, and it will be kind of a longer, maybe a 4 or 5 month correction after that. So the question is, are we in the correction, major wave 4 correction now, or is this a minor 4 inside the 3? All right, so that's a possibility, either one of those. And at this particular point, we have bearish divergence here. So I'm thinking it could go really either way, but long term, more highs are coming. All right. So again, markets are kind of funny right now. They're in that area where we've seen a little bit of a move up, yet not enough to really say we're out of the woods yet. Okay. So that's it. So wave 3 on the daily, Kumar. But if we look here, okay, let's take a look here. All right. This owl here, all right, needs to be higher than this one back here. And this one is still the higher one. So this is 2011. So this was a 3, 4, 5, 3, 4, 5. So we're in right now, as far as I can see, we're probably still in wave 4, minor 4, inside of 5 of 5, if that makes sense. Okay. So, if this owl then increases here and gets higher than this one, this one, then this would be a 3, and then we're really off to the races. Okay. But so far that hasn't happened. Now it says it's a wave 3 here, but that's a wave 3 inside of wave 5. Okay. Hopefully that is clear. Okay. Good question. All right. So that's it for today. All right. Any questions out there? All right. Again, I'm sorry I went a little over. Okay. But a good session nonetheless. All right. So thanks for being here. We'll be back next Wednesday. I think over the next week or two, the markets will probably give us a better indication of whether the correction is over or we're going back down. Again, if we go back down, I don't think it's a time to panic, because I just think it's more profit taking, and then eventually we should see the market recover. So I'm anticipating one more recovery in the market for that final push up. And the question is it going to come sooner or a little bit later this year? We'll have to stay tuned. Okay. All right. So thanks, everybody. And if you're our clients, we'll see you in the client support webinar in about 15 minutes. Have a great week, and we'll see you next week. I'll put a little music on before I end the session.